Welcome to the Deep Dive. This is your shortcut to being instantly well-informed.
We specialize in really tearing apart complex earnings calls.
And distilling them down into those few nuggets of knowledge that actually matter for you.
Exactly.
Today, we're diving deep into the retail giant Inditex. You know, the powerhouse behind Zara. This follows their H1 2025 results presentation, which happened back on September 10th.
Yeah. And this call was, well, it was a classic tale, really. The past results were complicated, maybe even a bit forgiven.
Forgiven? How so?
Because the future, or at least the very near future they presented, looks so bright. H1 was tricky, lots of macro forces involved.
So there was some caution initially?
Definitely cautious. But then management dropped their forward-looking trading update, and boom.
The whole narrative shifted.
Completely pivoted. The market just loved that structural confidence, and the shares reacted very positively.
Okay, so that's the tension we need to unpack for you, the listener. Let's start with the hard numbers first. H1.
Right. The first half, revenue hit $18.36 billion.
Which, as reported, is only 1.6% growth. That sounds, well, frankly, a bit sluggish.
It does on the surface.
Yeah.
But you have to strip out the currency noise. Constant currency growth was much healthier, 5.1%.
Right, 5.1%. That paints a different picture.
And even that 5.1% for the whole half kind of hides the specific pressure points in Q2.
Ah, okay. So Q2 is tougher.
Yeah, Q2 sales landed at $10.08 billion. The street consensus was actually higher, around $10.26 billion.
So slight miss there.
A slight miss. And that top line difference, that really shows the macro pressure playing out in real time.
You think if they'd stopped there, the reaction would have been negative?
Oh, absolutely.
Yeah.
If they just finished the quarter and said nothing else, we'd likely be talking about a significant stock dip.
But they didn't stop there.
No, they didn't. They immediately followed up that Q2 softness with the news that just changed everything.
Even though profitability kind of held up okay, net income was up slightly, 0.8%.
Yeah, profitability was stable, net income $2.79 billion. But the number that really moved the market, the big one, was about the start of the new season.
Ah, the trading update.
Yes, exactly. The proof, sort of their structural advantage in action.
What did they say specifically?
Inditex stated that store and online sales combined, and crucially, in constant currency, they accelerated.
Accelerated to what?
To 9% growth. That was for the period between August 1st and September 8th.
Wow, 9%. That's quite a jump heading into autumn-winter.
Massive momentum. It instantly validated their whole operating model, their speed.
So for you listening, the takeaway isn't really the slight Q2 revenue miss.
No, not primarily.
It's more about how quickly that engine revved back up once the new collections landed.
Precisely. That 9% figure, it's not just, a strong September start. It proved their investment in speed to market, lets them shrug off that historical noise and execute when the product is right.
And what's fascinating, you mentioned profitability held stable, but what about the gross margin through all that volatility?
That's another key point. Despite what management called that complex market environment, the gross margin held incredibly steady, 58.3%.
Only down 5 basis points year over year. That's tiny.
It's remarkably sticky. It speaks volumes about their pricing power and their inventory control.
And management seems confident that continues.
They do. They reiterated guidance for a stable gross margin for the full fiscal year 2025. They gave a range, plus or minus 50 basis points.
That's a pretty strong commitment, especially given the currency pressures everyone's talking about.
Which brings us neatly to those headwinds, yeah?
Yeah.
They actually had to revise their expected foreign exchange headwind on sales upwards.
Upwards. How much?
They now expect a minus 4% hit for the full year, FY25. That's up from the minus 3% they forecast before.
So a bigger currency drag.
A full percentage point bigger. Management was quick to frame it, though.
How so?
They called it a translation issue, mostly down to the weaker U.S. dollar, and insisted it's not a fundamental demand problem.
Okay, that's the official line. But, should we as listeners buy that completely? Does a weaker dollar translation hit not also imply maybe some demand softness in the U.S. market itself, sort of compounding the issue?
It's a totally fair question. And the fact that the big 9% acceleration number is in constant currency gives us some confidence. It suggests demand is strong where the product is actually sold.
Right.
The complexity, they keep mentioning, like U.S. tariffs, those negative FX swings, those seem to be genuine external factors hitting the sales line when it gets converted back to euros.
And they pointed to things they do structurally to manage that.
Yes, exactly. structural tools that mitigate the financial impact.
Yeah.
And that helps us, buy into that stable margin guidance a bit more.
What are those tools? They're key to their competitive moat, right?
Absolutely key. First, they just have decades of global experience managing tricky trade situations, tariffs, you name it. Second, massive diversification. They sell in 214 markets, and they source broadly too. Not all eggs in one basket.
And third, the one everyone talks about, proximity sourcing.
Right, that's the critical component. Sourcing, over half their stuff from nearby regions? Spain, Portugal, Morocco, Turkey.
Which lets them react incredibly fast.
Exactly. Replenish popular items in weeks, not months. That cuts lead times dramatically, slashes the risk of needing big markdowns on slow stuff. It's the ultimate margin protector.
And they were clear, pricing isn't about hedging FX.
Yeah, they confirm the policy is stable. It's driven by commercial goals, keeping their relative price position right in each market. They're not playing currency games with pricing.
They're prioritizing market share.
Seems like it, over those short-term currency gains.
Okay, so margin stability looks solid despite the headwinds. But did they have to sacrifice anything on the balance sheet? Anything in the, let's say, the plumbing?
Good question. We looked at operating working capital.
Which is usually negative for them, right? Suppliers and customers basically fund their ops.
That's the beauty of their model, yeah. It remained negative. But there was a temporary outflow in H1.
What caused that? Anything worrying?
They explained it pretty clearly. It was almost entirely due to payments normalizing after the Red Sea shipping disruptions earlier in the year.
So payments got delayed, now they're catching up.
Basically, yeah. Things slowed down, payments got pushed out. Now global shipping is more normal. Those timing shifts caused a kind of one-off cash outflow.
And they expect that to reverse.
Fully expect it to reverse and normalize next year. So it looks like more of an accounting adjustment, not a structural red flag.
Okay, good. So financials look solid, macro turbulence seems managed. The long-term story then really hinges on how they keep strengthening that strategic moat, technology, infrastructure.
Exactly. And the commitment there is massive. We're talking about that 2-year extraordinary logistics expansion plan.
Is that underway now?
Oh, yeah. The new Zaragoza, the second distribution center, for example, is fully operational now. That's a huge boost to capacity and speed.
And that's not cheap, I assume.
Not at all. They're putting $900 million per year just into logistics expansion through 2025.
And it's not just about building bigger warehouses, is it? There's a tech angle.
Definitely. AI is a big part of it. Their investment in a startup called Theker Robotics.
Theker Robotics, what do they do?
They focus on AI-driven logistics automation. It highlights how Inditex is baking speed and efficiency right into the operational DNA. This isn't just hype. It's tech improving the process from factory floor to store shelf.
Okay. And what about regular capital spending, ordinary CapEx?
That remains pretty disciplined, around $1.8 billion planned for FY25.
And focused on?
Squarely on the customer experience. Yeah. So store optimization, enhancing the online platform, and rolling out more tech in stores.
Right, the integration of physical and online, that's where it gets really tangible for us as customers, like the tech rollouts.
We're seeing a big push, like expanding that soft tag technology. It was done at Zara. Now it's going into Bershka and Pull & Bear.
Remind us what soft tag tech is exactly.
It's basically RFID, radio frequency ID, embedded in every single garment tag.
And the benefit is?
Near perfect inventory tracking across the whole system. Warehouses, trucks, stockrooms, shop floors.
Why does that matter financially?
Well, if you know precisely where every single item is, you basically never miss an online sale because the system thinks it's out of stock when it's actually just misplaced in a store somewhere.
Okay. Reduces lost sales.
Exactly. And it also radically cuts down on needing markdowns for stock that gets lost or sits hidden away. It directly protects that 58% gross margin.
Makes sense. What other tech are they rolling out?
Things to help staff efficiency, too. Assisted checkouts, those click and collect silos for faster online order pickups.
Like automated lockers?
Sort of, yeah. And also in-store sorters, which help staff quickly process returns or inventory that needs moving or replenishing, frees them up to help customers.
And the store optimization plan, still focused on quality over just quantity.
Very much so. They expect about 5% gross space growth between 2025 and 2026.
But that's not just opening loads of new small stores.
No. It's much more about relocating and significantly enlarging key flagship stores in really prime global locations. Quality space, not just more space.
Can you give examples?
Sure. Think about the Manchester Trafford Center project. They expanded the Zara there by 40%, or their big new concepts in high-profile spots.
And looking ahead, Any big refurbishments planned?
Yeah, for 2026, they mentioned plans for iconic locations like the New York Fifth Avenue flagship and the London Bond Street store. These are major statements about the value they still place on that physical storefront experience.
It's not just Zara either, right? They're expanding other brands.
That's right. Diversifying brand exposure, too. We're seeing strategic growth for the younger concepts, Lefties, for instance.
Lefties? How big is that now?
It operates 210 stores across 18 markets now. Pretty significant. And they're rolling out other brands into new countries like Oysho, moving into the Netherlands, Bershka into Denmark, finding new audiences.
And the U.S., still a big focus.
Absolutely. The U.S. strategy sounds quite aggressive, actually, and they confirmed it's on track.
What's the plan there?
To execute at least 30 significant expansion projects over 3 years. We're talking flagship relocations, big openings in major relevant cities like the recent LA Grove opening.
Okay.
Really securing prime physical spots in the world's biggest consumer market.
So it's this whole picture then, integrated growth, AI and logistics, fancy flagships.
It's a holistic view, yeah. Betting that superior execution, driven by their unique model, can basically trump these macroeconomic headwinds everyone's worried about.
Okay. Which brings us, as is our tradition here, to switch gears a bit.
Time for the This Is Not Financial Advices segment.
Exactly. Time for that outrageous but plausible trade pitch.
Yeah.
Designed purely to provoke some thought about how the market might be misinterpreting the signals.
Right. Let's put on our imaginary hedge fund analyst hats for a second.
I'm ready.
You've got this undeniable moment of dissonance, right? Q2 sales miss that screams macro risk, tariffs, FX, all that bad stuff.
But
then you have that 9% constant currency momentum screaming into Q3. That screams proprietary structural advantage winning out.
And the market consensus might be stuck on the fear.
Exactly. We think the street consensus might still be baking in just a bit too much macro fear, undercrediting the protective moat from near sourcing and that new AI logistics muscle.
Especially given management-guided stable margins, despite more FX pressure, that's confidence.
Peak structural confidence, arguably. So here's the pitch.
Let's hear it.
The trade. Consider buying long-dated, out-of-the-money call options on Inditex stock.
Okay, long-dated calls. Why out of the money specifically?
Because you want maximum leverage on the potential surprise factor. You're betting specifically that the 9% acceleration we saw in Augusta release September holds, or maybe even ticks up slightly, right through the really critical pre-Christmas trading period.
So if that momentum sustains.
If it sustains, then analysts who are still cautious will be forced, absolutely forced, to jack up their full-year sales and margin forecasts dramatically, probably way above current guidance.
Which could trigger a re-rating of the stock.
A steep, rapid re-rating, potentially ahead of the holidays. Look, it's not a safe bet, obviously. It's a high-leverage gamble.
A gamble on the structural advantage, just crushing the quarter.
Decisively winning the quarter, yes. That's the core idea. Don't fight the structural advantage when it's clearly flexing its muscles.
So, wrapping up the overall takeaway then.
I think it's that Inditex really did successfully navigate a complex Q2 using its integrated model. And that strong plus 9% trading update is the clearest signal that their execution is currently winning out over those macro pressures and FX noise.
And management keeps hammering home that idea, physical and online, totally integrated, inseparable, that unique model generating those strong margins.
Which raises a final provocative thought for you, the listener, doesn't it?
Go on.
What if this speed to market advantage, which is now getting supercharged by AI and their logistics, what if it fundamentally changes the whole industry's inventory risk model? Meaning maybe Inditex's steady 58% gross margin isn't the ceiling anymore. Maybe, just maybe, it's becoming the floor of their profitability potential.
Interesting. So the question becomes,
what specific proprietary tech, not just store count or marketing, but deep operational tech, should you be watching their competitors frantically try to develop just to keep up? What's the counter move?
a fascinating concept indeed. Something to mull over. Okay, before we sign off, one last concrete detail for any shareholders listening.
Yes, the dividend.
The final dividend payment for the 2024 financial year is 0.84 per share, and that's scheduled to be paid on November 3rd, 2025.
Good practical note.
All right, that wraps up our deep dive on the Inditex H1 call. Thanks so much for joining us.
And remember, as always, critical thinking remains essential.